Well, let's focus on the financial space now. RBI has tightened, AIF investing rules for banks and NBFCs to essentially prevent the risk of evergreening of loans. Rikin Shah is Vice President at IIFL Securities. He's joining us now to talk about this. By the way, yesterday we had clarifications from companies like Piramal, IIFL, etc. coming through. How big of an issue is this, Rikin? And will we hear more NBFCs coming out with their respective exposure and what they plan to do about it?
Okay, so thanks for having me on the show today. So in terms of the exposures of the banks and NBFCs, we have highlighted that the NBFCs are primarily the ones who are using this conduit to evergreen some of the loans. We had quantified the exposure of select NBFCs like Piramal, Edelweiss, Indiabull Housing Finance, IIFL Finance as well. Now within that, the impact of this ranges anywhere between 10 to 20% of the net worth of the select NBFCs that we spoke about. Banks have a much lower impact that would probably be in the range of low to mid single digit. Now, Piramal has put out a release as well as IIFL Finance has. Our sense is that there are going to be multiple second order impacts of this as well. Beyond the impact on the lenders, where they will be forced to take some provisioning, we see 3-4 impacts as well. Firstly, there will be redemptions of the AIFs being done by the banks and NBFCs. This means that today in India, the AIF size is around $40 billion. That includes many other VC, PEs, etc. as well. But as the redemptions come in, there will be mark-to-market losses for not only the banks and NBFCs, but other guys also who are invested into the AIFs. So that's point number one.
1 minute. Why will there be redemptions caused by? By the NBFCs, etc.
Because by the regulation, the RBI says
you
that
have to unwind.
You have to unwind within 30 days.
Right.
If you don't unwind in 30 days, you have to take the entire provisioning of those investments in your P&L.
Correct.
So there are only two options. So now if there are going to be unwinding, that is where there can be mark-to-market losses on the NAV for the holders of this AIF investments. So that's point number one. Point number two, with this regulation, the entire investable universe for the AIF also goes down because they cannot have an overlap in terms of the same borrower exposure as the bank and what they would invest in. Thirdly, in addition to the mark-to-market losses that we spoke about, we are also going to closely monitor some of the stressed accounts which were not recognized as NPAs until now could probably slip into NPAs in the coming quarters. Because this conduit has been now fixed, the loophole has gone, and that is where some of these accounts can slip into NPAs.
Okay, Rikin, hi, good morning. Thanks for being here with us in the studio. I wanted your thoughts overall on the financial space. Now, PSU banks have been doing very well, but your preference is private over PSUs even now. Why is that the case, and what are your top picks in the space now?
So here what we are saying is that the private banks have significantly underperformed in the last couple of years due to certain idiosyncratic factors and investor positioning. We see that changing now. The merger of HDFC is behind us, the management change at the Kotak is also behind us, and the Axis acquisition of City portfolio is also behind. So with all of those idiosyncratic factors coming to an end and the underperformance that we have seen, going into the next year, the reason why we prefer private over PSU banks is on account of three things. First, as the asset quality environment starts normalizing, we expect higher increase in the credit cost for PSUs versus private banks. Second, in terms of the capital raise impact for PSU, we already saw RBI tightening multiple regulations in last 1 month. That, coupled with the potential ECL regulations next year, means that the PSUs will need to raise more capital to fund their growth. And thirdly, unlike 2 years ago, the risk reward is no longer as favorable as it was in the case of PSU. So we have a preference for private banks. Within the private space, we like Axis Bank, HDFC Bank and IndusInd, and relatively a bit more cautious on Kotak.
Okay, all right. So we've got those picks in there again. But what about from the PSU basket? If you had to pick one, would you stick to the larger banks? Because some of these have already seen some bit of re-rating.
Sure. So we would stick with the larger names like SBI at this moment if one has to really invest into the PSU banks. But in the entire overall spectrum of things, we would still prefer private and some select NBFCs which can also be a beneficiary next year from the rate cut cycle.
Right. Rikin, sorry, just to go back to what we began with, which is the AIF thing, the third order impact that you said, right, which is that some accounts may slip into NPAs. Have you been able to, you would have a broad sense, right, which are the tricky accounts in that sense, and which are the impacted NBFCs, I mean, potentially impacted NBFCs? What's Yeah, go on.
So this will mainly be the accounts which used to be evergreen were largely in the real estate space.
Okay.
So we could see some of the potential names coming from them. Won't have the specific names here, but these are the some accounts which can slip. In terms of the NBFCs who could see some impact, it would be the same guys who have higher exposure to AIF as well. Having said that, even the banks who lend to the similar kind of borrowers may also see some impact. However, on a relative basis, the impact may not be as big for banks, but even banks might be able to see some downgrades of the real estate developer accounts as well.
For companies, for NBFCs, which have a disclosed exposure, and you're saying that more perhaps will do so, have you changed your earnings expectations, and have you lowered your estimates for these NBFCs?
So the names that are going to be largely impacted are the ones which we don't cover as yet, but
Okay.
it suffices to say that we would see earnings cut primarily to the tune of the 10 to 12% that we have been talking for some of the NBFCs.
Okay.
And do you, just one more thing, we saw this regulation coming in for RBI earlier, with the risk weights going up, right? Should we expect more? I mean, is this, and what are the investment implications we head into? We talk about PSU versus private banks, but also there was this case building up for NBFCs to do very well into 2024. Should one pull back that expectation a little bit as well and stick with large banks in that sense?
So the way RBI has reacted in last few months is not specifically targeting only NBFCs, but they have done a very decent job in terms of preempting where the potential risk could be in the system down the road. So even for the personal loan tightening, we have highlighted that on a top-down basis, there was no exuberance. But the scorching pace of growth by some of the NBFCs within short span of time was creating a problem. And that is where our assessment was that fintechs and some of the NBFCs who originate these loans via fintech would be primarily impacted. Even this regulation today, most of the evergreening which used to happen over a period of time has subsided, given the real estate cycle in India also has revived. So the way I think about this is that RBI has been acting preemptively to curb some of the risk in its bud.
All right, we'll let you go on that note. We've run out of time, but thanks a lot for joining in, and thank you for explaining to us this entire issue and how to approach banks. By the